Hello and welcome to the April 14th, 2023 episode of Watching the Tape. Tax day is next Tuesday, so I thought it would be fitting to cover some tax planning related topics this week. Tax planning methods can range from the obvious ones like deferring income into an IRA or 401k to the slightly less obvious methods like Roth conversions or donor advised funds, all the way to the obscure methods like the ones that I want to highlight today. And I picked three that I've encountered myself. Number one, realizing capital gains in the 0% tax bracket. And for this one, we're going to go to my favorite tax planning software, which is Holistiplan. And we're going to walk through a scenario with John and Jane Jones. So they recently retired. This is a hypothetical couple, of course. They just retired this year. So this is for 2023 that we are going over. And Jane actually did a little work this year. So wage income is going to be $25,000. Taxable interest of $10,000 is expected over the course of the year. Total dividends generated from their portfolio will amount to about $20,000, of which $15,000 will be qualified dividends. All right, so let's go to the summary tax report, which sort of converts all the tax information into numbers and tables that are a lot easier to understand and follow. Okay, so remember, total income was $55,000. So it was $25,000 of wages plus $10,000 of interest plus $20,000 of total dividends. Now, if we go down to the ordinary income tax brackets, and we see it says you, in this case, it means John and Jane Jones. The income, the taxable ordinary income, is $12,300. So how do we get to that? So ordinary income is the wages, $25,000, plus the interest of $10,000, plus the $5,000 of non-qualified dividends. So that gets you to $40,000 less the standard deduction of $27,700. So that's where the $12,300 comes from. Firmly in the 10% tax bracket. All right, let's scroll down to the capital gains and qualified dividends tax bracket table. And in this case, it shows you, John and Jane Jones, at $27,300. So that is the $12,300 plus the $15,000 of qualified dividends. And you can see here that that $15,000 is being taxed at 0%. So go up to their total tax bill projected for 2023. It's going to be $1,230. That's great. Is it time to move on? I would think not. I would think there's some opportunity here for the Joneses to take advantage of being in such a low tax bracket because it's a low income year. All right, so let's say, for example, we'll go back to the data input tab, and let's say that we want to, John and Jane Jones have been pretty good investors, and they have a taxable investment account with substantial unrealized gains. So this would be a great time to sell some of those securities and realize those gains. So let's say they realize $60,000 in gains. Now, if we go to our summary tax report, we'll update this, see what it does to our tax situation for the Joneses. Doesn't change ordinary income, still $12,300. But you can see that it does change the amount in the capital gains and qualified dividends table. All right, so the Joneses in this case have income for these purposes of $87,300. That is still below the threshold that would put them into the 15% capital gains tax bracket. So that starts at $89,250. So this $75,000 right here is being taxed at 0%. And that $75,000 is composed of the $60,000 and realized capital gains, plus the 15,000 of qualified dividends that are taxed at these more favorable rates. Can't get much better than 0%. All right, number 2. Don't miss an opportunity to realize capital losses. And I don't have an illustration here, but the situation is this. Let's say the clients have an investment account in a community property state like Washington. And within this account, there are securities, or let's say one security with a unrealized capital loss. So let's say they bought a high-flying tech stock a few years ago, and it's declined in price and is now well below its original purchase price. So unrealized loss. Unfortunately, one of these spouses is in poor health and is starting to make end-of-life plans. If the surviving spouse does nothing before the death of his or her spouse, there would be what's called a step down in basis for that stock holding, meaning that the spouse, the surviving spouse, would have missed an opportunity to sell that security and realize those losses. Realized losses can be used to offset ordinary income up to $3,000, or it can be used to offset capital gains without limitation. The last thing that a surviving spouse should be thinking about when he or she is losing a loved one is realizing capital losses. I get that. So this is where a financial advisor working behind the scenes can execute the appropriate trades to make sure that an opportunity like this isn't missed. And then number 3, be mindful of IRMA surcharges. So IRMA stands for Income Related Monthly Adjustment Amounts. And it's a surcharge that is added on top of the standard premiums for Medicare Parts B and D if the client's income exceeds certain thresholds. So for this, we're going to take a look at Bob and Susie Johnson. And we're going to go straight to the summary tax report page. All right. So Bob is 75 and he's been collecting, he's been pulling his RMD, or his required minimum distribution, for a few years now. Susie turned 73 this year, and so she'll need to start taking RMDs from her IRA. But she has the choice. She can take her first RMD in 2023 or postpone it to the following year, as long as she takes it before April 1st of 2024. If she elects to take her first RMD this year, and let's say the amount is $30,000. Let's look at this table. So right now, if you look at their income, which is composed of Social Security, Bob's RMD, a pension, interest, dividends, their total income is $240,000. All right. So if Susie takes a $30,000 required minimum distribution from her IRA, that would put them at $270,000, which would put them firmly in the next bracket here, or threshold, meaning that 2 years down the road, there would be a surcharge levied on top of their existing Medicare Parts B and D premiums. So, and look at this on an incremental basis. So it'd be 165 over the base level. So it's really a difference here of, let's say, $100. And in this case, for Part D, it would be $20. And that's monthly times both of them. So if you do that math, you get close to $3,000 on an annual basis. Not gonna break the bank for this couple, but if you can, why not just delay that surcharge adjustment by 1 year? So as I wrap this up, what should be a key takeaway from this video, because I don't expect anyone to rush out and implement any of these maneuvers right this very moment, because I doubt that any of these apply to you. Maybe the first one about realizing capital gains in the 0% tax bracket, that has a bigger window to execute on than the other two, that's for sure. The point of this video is that you should always be mindful of tax efficient maneuvers throughout your life. Different opportunities present themselves at different times. So it's really important to be alert so that you don't miss good opportunities. Tax planning is about reducing your overall lifetime tax bill. There's conventional wisdom is that you should always just defer taxes. That is not always the best approach. That's it for this week. Thanks for watching. We'll see you in 2 weeks.